Assalamualaikum and hi everyone. So today we would like to discuss about the past year question, which is the July 2025. Before we start, I would like to introduce our team members. The first is Nur Shahira binti Muhammad Zaidi, Nur Izzatul Khadijah binti Muhammad Rasid, Nur Amalina binti On, Nur Amira Shahira binti Muhammad Jafri, and Nur Ainul Erni binti Awang.
Assalamualaikum and good morning everyone. My name is Nur Shahira binti Muhammad Zaidi and I'm from JBA 2724B. I will be presenting question 1, which is about FCPO futures contract and market-to-market calculation. In this question, Mr. Ali expect the price of crude palm oil to decline in the near term because he expect the price to fall. He decide to take a short futures position at 4185 ringgit per contract. The initial margin required is 10,000 ringgit per contract, while the maintenance margin is 8,000 ringgit per contract. This question has 3 parts. First, I will explain the market-to-market report. Next, I will calculate the profit or loss if the position is closed on day 4. Finally, I will explain how a trader close a short futures position before expiry. Now, let's move to part A. Since Mr. Ali expect the price to decrease, he opened a short futures position. He trades 8 contracts and each contract represents 25 tones. Therefore, the total initial margin is 80,000 ringgit while the maintenance margin is 64,000 ringgit Malaysia. The market-to-market process adjusts the margin account every day based on the daily price movement. Based on the table, on day 1 and day 2, the price decreased. So, Mr. Ali earns a profit because he is holding a short position. On day 3 and day 4, the price increased, so he experienced a loss. Lastly, on day 5, the price falls again, so he makes another profit. Throughout the 5 trading day, the margin balance remains above the maintenance margin of 64,000 ringgit Malaysia, so no margin call is required. For part 2, we need to calculate the profit or loss if Mr. Ali closed his position on day 4. We compare the margin balance on day 4, which is 79,800 ringgit with the initial margin, which is 80,000 ringgit. The calculation is 79,800 ringgit minus 80,000 ringgit equals negative 200 ringgit. Therefore, Mr. Ali incurs a loss of 200 ringgit because the margin balance at the time he closed the position is lower than the initial margin. For question B, my answer is, since the trader opened a short position, he needs to close it by buying back the same number of June 2025 FCPO contracts. This is important to avoid physical delivery. If the position is held until expiry, the seller has the obligation to deliver the FCPO to the designated delivery point. Closing out the position before expiry allows speculators to settle the contract in cash rather than handling the physical goods.
Thanks, Shahira. Before I start, I would like to introduce myself. My name is Nur Aini Erni binti Awang. Now, I explain question 2, which is about arbitrage using CLIBOR interest rate and FKB3 future. First, we calculate the implied forward rate IFR based on the given CLIBOR rates. The IFR is 5.47%. Next, we calculate the fair value using the formula 100 minus IFR. So, fair value equal 100 minus 4.47 equal 94.53. We then compare the quote future price with the fair value. The quote price is 93.50 while the fair value is 94.53. Since 93.50 is lower than 94.53, the future contract is underpriced. Therefore, the appropriate arbitrage strategy is to buy the FKB3 future, borrow short term and lend long term in the cash market. Next, we calculate the number of contracts, which is 5 contracts. Then, we calculate the future profit using the formula sell minus buy times 100 times contract value times NOC, giving us a future profit of RM 80,750. For the cash market, the borrow short term is RM 25,000, the lend long term is RM 93,750, and the rollover borrow is RM 62,500. Finally, we calculate the total arbitrage profit using the formula future profit plus interest earned minus interest paid minus rollover cost. Therefore, the total arbitrage profit is RM 25,000. In conclusion, since the FKB3 future contract is underpriced, the dealer should buy the FKB3 future and implement this arbitrage strategy to earn an arbitrage profit of RM 25,000. Now, I will explain the question 2B. This question asks us to explain how financial institutions use FKB3 future to hedge against interest rate risk and the relationship between CLIBOR and FKB3 future price. Financial institutions use FKB3 contracts to hedge against interest rate risk. If interest rates are expected to increase, they will take a short future position to offset higher borrowing costs. If interest rates are expected to decrease, they will take a long future position to protect the value of future investment or interest income. This helps reduce losses caused by interest rate fluctuation. The relationship between CLIBOR and FKB3 future price is inverse. The future price is determined by the formula FKB3 price equal 100 minus CLIBOR rate. Therefore, when CLIBOR increase, the FKB3 future price decrease. Conversely, when CLIBOR decrease, the FKB3 future price increase.
Hello, I'm Izabul and today I will explain question 3 July 2025. In this question, the portfolio manager is worried that Malaysian stock market will go down. The portfolio value is RM12.8 million and the portfolio beta is 0.80. The manager wants to protect the portfolio from losing value. First, we choose the strategy. Because the manager already owns the shares and expect the market to fall, we use a short hedge. This means we sell FKLI futures contracts. We use a short hedge because when the market goes down, the portfolio loses money, but the futures position make a profit. The profit from the futures helps to cover the loss from the portfolio. Now, we calculate the number of contract. The formula for number of contract is amount to hedge times with percent of hedge times with beta, then divide with futures price times with contract multiplier. So, RM 12.8 million times with 0.90 times with 0.80 divide with 1585 times with RM 50. So, we will get about 116.29 and we round it to 116 contracts. Next, I will explain this hedging process table. This table is divided into two parts. On the left side, it shows what happened in the stock market, but on the right side, it shows what action the portfolio manager takes in the future market. First, let's look at today. On the left side, the portfolio manager owns a portfolio worth RM 12.8 million. He expects the stock market to go down and the current FBMKLCI index is 1580 points. So because he expects the market to fall, he wants to protect the value of his portfolio. To protect the portfolio, the manager opens a short hedge. This means he sells FKLI futures contract at 1585 points. The reason he sells first because he expects futures price to fall together with the stock market. Now let's look at second row for 3 months later. The manager still owns the same portfolio, which is the market index has fallen from 1580 to 1500 points just as expected. So the portfolio lost some value because the stock market has gone down. To close the hedge, the manager now buys back the FKLI futures contract at 1500 points. This is called the offsetting position. He sold at 1585 and moved back at 1500. So he earns a profit from the futures market. The profit from the futures contract helps offset the loss in the stock portfolio. Next, we calculate the number of future position. The formula is selling price minus with buying price times with NOC times with RM50. So 1585 minus with 1500 times with 116 times with RM50. Then the answer is profit RM 493,000. Then calculate the cash position in this situation shows decrease in price. So the formula is ND index minus with beginning index times with amount to hedge divide with beginning index. So the answer is negative RM 648,101.27. For net effect, the formula is future profit minus with loss in cash position. So RM 493,000 minus with RM 648,101.27. And the answer is negative RM 155,101.27. Last is effective price. The formula is total value of investment divided by NOC times with RM50. So RM 12.8 million minus with RM 648,101.27 divide with 116 times with RM50 and got the answer is negative RM 2095.15. Next, for question 3B, portfolio managers use FKLI to protect their portfolio against systematic risk, which is the risk caused by overall market movements. There are two hedging strategy, which is the first one is short hedge. A portfolio manager use a short hedge when they expect the stock market to fall. The manager sells FKLI futures contract today, and if the market falls, the portfolio lost value, but the futures position earns a profit. The futures profit helps offset the loss on the portfolio. The next strategy is a long hedge, which is a portfolio manager use a long hedge when they expect to receive a cash in the futures and plan to buy shares later. The manager buys FKLI futures contracts today. If the market rises, the futures position earns a profit. The futures profit helps offset the higher cost of buying shares later. So that's all from me. I will pass to Amalina.
Thank you, Izatul. My name is Nur Amalina and I will explain question 4A. First, we need to identify the market expectation given in the question. The analyst expects market yields to fall. Since FMG5 futures price move inversely with yields, when yields decrease, futures price are expected to increase. Therefore, the most suitable strategy is a bull time spread. A bull time spread is used when we expect the price of futures contract to increase over time, especially when the longer term contract is expected to increase more than the shorter contract. To implement this strategy, the analyst will sell 10 September 2025 FMG5 futures at 105.2 and by 10 December 2025 FMG5 futures at 105.06. Later in September 2025, the positions are closed by buying back the September futures at 110.55 to close the short position and selling the December futures at 113.9 to close the long position. So basically, the analyst will make money if the December futures increase by more than the September futures. Next, I will explain how the profit is calculated. Let's start with the September futures. Since we initially sold the September contract at 105.2 and later bought it back at 110.55, the price increased. Because this is a short position, buying back at higher price result in a loss. The calculation is 110.55 minus 105.2 equals to 5.35 points. Each point is worth 100 ringgit. So 5.35 times 100 times 10 contracts equals 53,500 ringgit loss. Now let's calculate the December futures. We bought the December contract at 105.06 and later sold it at 113.9. Since this is a long position, selling at higher price generates a profit. The price difference is 113.9 minus 105.06 equals 8.84 points. So 8.84 points times 100 ringgit times 10 contract equals 88,400 profit. Next, we calculate the gross spreading profit. 88,400 ringgit minus 53,500 ringgit gives us 34,000 ringgit 900. Finally, we deduct the commission. There are 20 contracts in total because we trade 10 September contracts and 10 December contracts. The commission is 100 per contract. So 20 plus 20 times 100 ringgit equals 2,000. Therefore, 34,900 minus 2,000 give a net profit of 32 ringgit 900. This strategy is profitable because December futures increased much more than September futures. Next question 4B. Factors to consider when selecting a specific contract. First, FMG futures can be used to speculate on future interest rate movement in Malaysia based on the investor's market outlook. Second, FMG futures price move inversely with interest rate. When interest rate only falls means FMG futures price rise, while when interest rate only rise, FMG futures price will fall. Third, if the investor expects interest rates to fall, he has a bullish outlook. Therefore, he should buy FMG futures and sell later at a higher price to make profit. If the investor expects interest rates to rise, he has a bearish outlook. Therefore, he should sell FMG futures and buy back later at lower price to make profit. Lastly, the investor should select the contract based on the timing of his market outlook. A near-month contract is suitable for short-term outlook, while a distant month contract is suitable for longer-term outlook. For the conclusion, therefore, FMG futures allow investors to profit from expected movement in interest rates by taking long or short futures position.
Thank you, Amalina. Next, my name is Nur Amira Shahira binti Muhammad Jafri, and I will explain how to answer question 5 about option strategies. First, we need to look at the option quotation given in the table. There are two call options with exercise price 1320 and 1620, and also have two put options with exercise price 1320 and 1580. The premium are also given, so we must choose and correct strategy based on each scenario. For question 1, the keyword is moderately bullish with limited profit and limited loss. Bullish means we expect the market price to increase. Since the profit and loss must be limited, the best strategy is bull call spread. It's proven by long call premium that are higher than short call premium. We buy the lowest strike call at 1320 and sell the highest strike call at 1620. This strategy is suitable because the investor can gain profit when the market increases, but the profit and loss are both limited. BEP point same with the at the money point, and out the money plot is before BEP. For in the money plot, it's after BEP. Next, for question 2, the keyword is the price will not move significantly higher or lower. This means the market is expected to be stable or have low volatility. Based on textbook page 218 and 219, the only strategy that has low volatility is strategy short strangle. So, the suitable strategy is short strangle. In this strategy, we sell one call option and sell one put option with different strike price. The investor earn premium income and the maximum reward is the total premium received. This is the graph for short strangle strategy. BEP point same with at the money point, and out the money plot is before BEPB and after BEPA. For in the money plot, it's happened between BEPB and BEPA. Then we look for question 3. The keyword is the price is expected to descend, mean the market price is expected to fall. At the same time, the investor want to limit loss. Limited profit also happen because companies need to sell option after buy option. Therefore, the best strategy is bear put spread. We buy a higher strike put and sell a lower strike put. This allows the investor to gain when the price falls, while keeping the loss limited. This is the graph for bearish put spread strategy. BEP point same with at the money point, and out the money plot is after BEP. For in the money plot, it's before BEP. Next, for question 4, the keyword is high market volatility, and the investor want to buy both types of options. The profit is unlimited, however, the loss is limited. Two options that I choose is long strangle and long straddle. However, the call strike price is slightly higher than the put strike price. So the strategy long strangle is more suitable for this question. We buy call option at RM1620 with premium RM50 and buy put option at RM1320 with premium RM19. Total premium paid is RM114. The upper break-even point is RM1620 plus RM140, which equal to RM1760. The lower break-even point is RM1320 minus RM140, which equal to RM1180. This is the graph for long triangle strategy. BEP point same width at the money point, and out the money point is between BEPB and BEPA. For in the money point, it's before BEPB and after BEPA. Lastly, for part B, short triangle means selling one call and one put with different strike price but the same expiry date. This strategy is suitable when the market is expected to remain stable. The maximum reward is limited to the total premium received, but the risk can be very high if the market moves sharply upward or downward.